Hello and welcome to the Property Trio. I am playing host today and I feel rather spoilt because I've got awesome notes and you two have done all the work. Mike and Dave.
Mostly Mike.
Mostly Mike. Oh, I saw you chimed in. You're pretty good. This is a very exciting one for you. I'm surprised Mike stepped outside of his wheelhouse and gone into mortgage territory. But
Yep.
Well, it's such a topical. Yeah, exactly.
had your head in Google all week, haven't you, Mike?
Yeah. ChatGPT has written a great episode. None of it makes sense. Some of it's related to America. But we'll have fun.
Unreal. Well, how are you both?
I'm really well, thanks, Kate. What about? I had a very busy weekend. We had lots on. The basketball team I helped coach went from sneaking to the fore to beating the undefeated top team in the first final. So there was a lot of happy boys and parents on Saturday afternoon, and we won by 1 point.
Oh, that's a good game.
And so there was a few celebratory drinks afterwards as well down at the local governor. So that was a real highlight of the weekend.
And is that Lukey or Josh?
That's Luke.
Oh,
Luke's team.
Very good work, Luke. That's ace. Mike, what about you? You're over your man flu. Your kids are well?
Yep, they're going good. They're still little terrorists keeping me on my toes. But I'm flying to Port Macquarie this weekend, weather permitting, so I'm looking forward to that.
Oh, I was about to
Awesome.
ask you when we're doing our little aviator flight and heading over
Well,
to...
you guys seem to be allergic to New South Wales, so you've got to head up this way.
Well, Dave wants to fly in with his new mate in a plane to show off to his brother-in-law and sister.
Pull up at the golf course.
And parents. Yeah, we'll just land on the public golf course up at Nambucca Heads.
Yeah.
It's a slippery slope,
Don't.
Dave. After that, then I think you're going to have those like diamond things glued to the front of your teeth. You know,
Right.
Be careful.
Well, I already wear them on weekends, Mike.
you?
Didn't you know that? Yeah.
No, we'll have to organise that flight.
So-
It's a work in progress.
It's that Paul Simon song, Diamonds on the Soles of Her Shoes.
Oh, there you go.
I'm showing your age
Maybe we
now.
can do that. Great album, Graceland.
Yeah. All right, we're going to crack into this awesome subject. Mortgage cliff. You know, we're all hearing about it. It's in the media. Everyone's talking about this amazing, colossal property crash that's going to come and enable them to go and buy cheap property. But let's pull that apart and test the theory. Mortgage cliff, mortgage stress, and the implications for the property market. You have been busy, haven't you, Mike?
It's a grandiose title, isn't
It's
it? Let's see if
awesome.
it lives up to it.
Yeah. Well, you've
Oh, it's so
chosen-
topical, isn't it?
It is. Not everybody's talking about it. A lot of people are hanging their hat on this, and we've seen it over the years when the media have talked up something, and there's been a significant, usually mortgage-related or legislation-related set of data or a timeline with an end
Yeah.
date. And when we put this into perspective, you know, a lot of people are fearful about something that may be a bit of a fizzer.
Yeah, the roof often doesn't cave in, does it? And look, actually, one that just came to mind is Y2K bug was an example of massive beat up, all the worries about what was going to happen when we ticked over to the year 2000, and basically nothing changed.
Yeah.
Everything
for all
still
those
worked.
people
Planes
that had-
didn't fall out of the sky.
Gallons
There
of
was a
rice
couple
under
of-
the house.
There was a couple of Nostradamus predictions in and around that time as well, that the world was going to end. I can remember sitting out the front of a service station with a bunch of mates, and I just kind of thought, is this the best place to sort of see it out? As much as I love petroleum. It's really...
In your hand.
yeah. Oh, I don't think I did.
All right, well, you've chosen today to discuss the pending mortgage cliff the media have been talking about for a while, and you've catalogued some of those articles. What did you find?
Yeah, well, I wanted to just sort of dive into it because it's something that has been featured in the media on and off for a little while, and I just thought I'd take the pulse of the media. And the ABC had an article entitled "Millions on Mortgage Cliff as They Roll Off Low-Rate Home Loans and Hit a Wall of Repayments." I think we'll probably try and debunk that million figure in a moment. And people like Mark Burris in July and August via news.com warned us that families will sell their home within months as the mortgage cliff erupts. So, you know, it was pretty emotive stuff, and there's no doubt the data was showing some concern in the figures, like 800,000 home loans, which is worth about 350 billion, are expected to transition from the fixed interest rate to the higher variable rate, and that's the big thing, right? It's the difference between that fixed rate and the variable rate. But I wanted to see how this actually impacted mortgage stress and mortgage delinquencies, more importantly, how many people were actually behind on their mortgage. And given that June was the month that the majority of the fixed rate credit was due to roll over, and 1/3 of fixed loan terms will have expired by now, I thought now is probably the time to have a good look at the data.
Yeah, totally agree. Dave, can you explain to us what the mortgage cliff is and why it's been such a concern?
Yeah, so look, the mortgage cliff, it's just referring to a large volume of loans having their fixed rate period expire. The concern is that borrowers won't be able to refinance and or afford their new repayments. The fixed rates became incredibly popular during the pandemic, and at their cheapest point in May 2021, the average new fixed rate home loan for 3 years or less was 1.95%, which we spent a fair bit of time talking about on the podcast. And, compared with the variable rate at the time of 2.8%, which is what some RBA data shows. So there was a big disparity, bigger than it's probably ever been that I can recall in sort of 25 years of being in mortgages and property. So, as a result, a lot of borrowers took a gamble that interest rates were not likely to fall further by locking in the lower rate. And by mid-2021, about 45% of new loans being written were fixed, compared with just 5% today, which was off the charts. We're historically a country that prefers variable rate loans, and they tend to win in the long run. So, there are 5-year fixed rates as low as 2% for quite a period of time. But, the banks were very smart, and they thought that this cost of funding is unlikely to stay low for a long time, irrespective of what Governor Lowe was saying to the public. And therefore, they really targeted offering superior deals for just 2-year fixed rates, with the hope that, or expectation that rates might start to rise again. They also had the term funding facility that the government had given them, which they knew wouldn't be around forever. And unfortunately, a lot of borrowers and lenders and brokers, I guess, put people on 2-year fixed rates rather than 3 and 5 years. So, we were talking about the advantages of fixing in our episode number 83 on the 8th of Jan 2021, when 3 and 5 year fixed rates were like 2.1 to 2.7, and
Great
again
memory,
on.
Dave.
Why didn't people take longer fixed rates? I really want to know, because we did. I'm not saying I'm a genius. In fact, you gave us a lot of a heads up, Dave. But why wouldn't people? Even, if you can get a 2-year fixed rate for 1.9% and you've got to pay an extra 20 basis points to get 5 years of 2.1%, why wouldn't you do it?
From my experience, what happens is people have a set of rates in front of them that from a broker or a lender, and they just often gravitate to the lowest rates. And so often there's, with the 2-year fixed rates, especially when they have a bit extra of a discount, often between the 3 and 5, the longer you fix, you go up by about 10 basis points, 15, 20. So when there's a bit of an extra incentive for one of the periods, people just tend to gravitate to it. And that's, that's what I think happened. And it happened with clients of ours, and it's just surprising. We did lock in for the first time ever for 5 years personally. And, so that's all I can put it down to. It's the old, what is it? The mozzie, the mozzie to the light or whatever.
Yeah, well, I just wonder, do we not think about money in the same way we think about other things that are pleasing? So, for example, if the local pub told you that you could have a pot of beer for $2 for the whole year, or for $2.40, you can have that same pot of beer for 5 years, you'd pay the $2.40, wouldn't you?
Yeah, I think so. Yeah.
We didn't think about money in the same way we think about,
I think that's just evidence that beer is more important than your mortgage.
We make better decisions when we're
Similar
about
ratio,
to drink
though.
beer, maybe.
You think about, like the cost of beer, a pot of beer for $2, it's about right.
Well, I think people research their next television or their next holiday decision a lot more than they tend to research their mortgage. I mean, how many people would read a product disclosure statement and things like that? And like you said before, I don't profess to be any different. I think that's just part of human nature. It's not a great part of human nature, but I think that's just the reality.
Yeah, there's a fair bit of psychology to it. I think we're trained to gravitate towards lower rates because all the marketing that bombards us about low rates, get to the lower rate, select the lower rate, and so I think people, sometimes make those shorter term decisions, and
that's why they invented the comparison rate. If we think about it, you guys will both, well, you should remember, Mike, when the comparison rate was introduced and it was mandatory for brokers to share that, because we had all of these honeymoon rates prior to that mandate that would lure people in, and they'd actually have a more expensive loan.
Mm-hmm. Yeah. So hence a lot of people are coming off now when they could have fixed for longer, and especially up to 5 years.
And I love that you're that teeny tiny little line at the very end of the chart, Dave. You come off in like 3.5 years.
Yeah, when the interest rates are probably exactly what you'd already fixed them as.
Why not?
Call that a soft landing.
Hopefully.
Yeah.
Mr. Tontine.
Yeah, one of my cousins and her husband fixed for 5 years at like in the low twos. It's unbelievable. So they really nailed it.
Yeah, very much so. And look, the flow-on effect that a decision like that can have with your wealth creation and your ability to commit to other things is enormous.
Yeah.
So, Mike, what do we know about the contributors to loan arrears?
Well, thankfully, the RBA, we talked about Mr. Lowe's comment about interest rates not going up. They do some good things as well. The RBA published a research paper, which is slightly even more grandiosely named than the title of this podcast, The Determinants of Mortgage Defaults in Australia, Evidence for the Double Trigger Hypothesis. Doesn't that sound fancy?
It's like, a science exam or something like that.
I know. You should see some of the statistical formula in there. They lost me. Like, as soon as you see those back to front Zs, I sort of start glazing over the eyes. But what they found in pulling the conclusion out is that negative equity is really strongly correlated with whether a loan is in arrears or likely to transition to arrears or foreclosure, as well as unemployment and reductions to income being the key driver of arrears. So that kind of makes sense, right? It requires a shock to your income generation ability and negative equity. I think negative equity is a greater stressor, and they also found that negative equity means you're sort of more likely to go backwards on your home loan, because it's sort of like the psychological idea of paying for something that you've kind of overextended on.
Well, let's define
that's
negative
interesting.
equity. Most people, no, I shouldn't say most people, a lot of our listeners will understand that term, but for anyone who doesn't, negative equity means that you owed the bank more than your property is worth. So that can come about from a couple of things. It can come about from price decline. So if you've got massive price falls and all of a sudden your asset's worth less than what you borrowed for it and way less than what you paid for it, or if somehow you've been borrowing more and more money. And it's much harder to get yourself into negative equity by borrowing more money unless you've got a pretty sophisticated setup. And Dave, you could touch on that, but I don't want to take us off course. I just wanted to define what negative equity means. If you're sitting on a loan that's bigger than the value of your property, you'll be feeling pretty stressed about all of that. And Mike, you're suggesting that behaviours that people exhibit create that kind of stressful position in the first place.
Yeah, and I think they're less likely to want to stay on top of a mortgage that's in negative equity because they feel like it's a loss position.
Yeah,
I think that was
that's
the
interesting
implication from the paper.
Yeah. So the drive to want to make your repayments once the property value is less than your debt reduces significantly because you don't feel like you've got any asset value in that property. That's quite an interesting insight, isn't it?
Yeah, you don't believe in the future of that asset and your position, which is an interesting one. The paper also gave an idea of, well, what policies can we create to lower the rate of mortgage defaults? And unsurprisingly, they said promoting low unemployment and stable macroeconomic environment. They also talked about lowering LVRs, which is obviously a real easy one, right? Like if we cap LVRs at 50% of the loan value, then the chances of being in negative equity are probably nil. But they basically said, well, you can't, it's not really an achievable policy because the risks of tightening credit supply, we know what happens. We've seen that anecdotally in the past with things like the APRA intervention and the Royal Commission. It's not good for the economy to restrict the flow of capital.
That's so true. Remember when they did that in 16 to 19, and they did all kinds of things to reduce credit, and they certainly capped LVR, especially for investors. But, household debt was of a concern at that stage, and they got us in pretty good shape to weather some storms ahead. But it's such a difficult tightrope for them to walk because they also crunched credit and led us into a property downturn in 2019 because it all just dried up.
Yeah, and look, these things happen in the real world. Having had staff with us who've come from Sri Lanka, for example, or staff based in offshore as well. Some countries like Sri Lanka, Nepal, or others, they only can lend 12 ERs of 40%, 50%, 60%. They can't go to 80% or above like we can. And so we're only able to do that because we're a really stable and strong economy. And so, these things actually do occur at extreme levels, in more, I guess, third world countries where the loan to value ratios are really low.
Dave, do you remember the days of 104 just before the GFC?
Yeah, I got to 106% even. You could borrow the full purchase price plus costs.
And that was
just before the GFC hit.
And we had grants as well, first homeowner grants, and you could put that towards your purchase. So we had a lot of people just using their grant and buying stuff out in the greenfields estates.
We just started the adjustable rate loans, which meant your loan was really low for 1 or 2 or 3 years and then would go up later on. And thankfully, we're quite a few years behind the US with implementing these high-risk products. And then the GFC blew up. So we were fortunate. There was only about 3% of all our loans were non-conforming loans, whereas in America it was about 15%.
Yeah, scary times. We digress. Paper can talk about ways to reduce the chances for mortgage arrears, but we know how damaging constricting the money supply can be for the economy and the property market. Dave, how many buyers in the last few years would likely be in negative equity?
Well, AMP back in March said that Australian national dwelling prices have declined by about 9% since their peak in April 2022, so the recent fall in prices that we're all well aware of. And that took prices back to the July 2021 level. So, we're talking a bit over 2 years ago. So on the Reserve Bank of Australia's own figures, 0.5% of loans are currently in negative equity. So very few. AMP predicted another 10% drop in property values along with many other lenders. And we all know that hasn't happened. In fact, it's basically been the opposite. That's eventuated. So essentially property values have been rising, through the data since about March, but probably in reality, because of the data lag since the start of this year, we've had a turnaround. So, there's, as we just said, there's very few in negative equity. So Mike, what is the state of these expiring fixed rate loans right now?
Yeah, well, I found we're about halfway through the expiration of the fixed rate loans, the nasty loans that I think the media is zeroing in on. So there's $350 billion of those moving to variable. And CBA has probably the lion's share or pretty close to about 52 billion of those mortgages. And they said arrears for loans rolling onto variable were in line with their its broader portfolio, whatever that means. But 30-day arrears were just 0.92% and 90-day delinquencies were 0.43%. So I think that's evidence that the cliff is more just sort of like a embankment, perhaps. Choose your own downwards.
Nice little,
metaphor.
Hill.
In saying that, though, I think there's going to be a continued drop in consumer spending, and there will be a hangover of these loans. And now, when we talk about the RBA's advice on creating an environment that is not conducive to arrears, they're talking about a stable macroeconomic environment. And I suppose when you contrast it to places like Nepal and Sri Lanka, as you were saying, Dave, we are stable, but the pace of change in interest rates is not typically stable from an Australian point of view.
Yeah.
So I think that there will be certain households that really suffer from just the speed of those changes when they're looking to refinance. And those who took out the loans in the last 3 years are about 62% of outstanding loans. So that is not a great sort of time strategically to be fixing on that low interest rate, because chances are you're going to be coming off at a higher rate. But we're stress tested at the higher rates. There's still data saying that people are contributing up until recently more than their actual mortgage cost. Now that is certainly dropping, but I don't see the doom and gloom that everyone else is talking about in the media.
Yeah, well, we've spoken a number of times about the explosion of lending activity due to refinancing. What are we saying here?
Well, according to the ABS figures for July, and we've shared some of these in some of the market updates recently, the value of new housing lending continued to fall in July, but the value of external refinancing was the highest it's ever been. So it hit another record. So that rose 5.4% last month to a record high of 21.5 billion, which, at the end of the day, it's a number. It's just a big, massive number we struggle to relate to, but basically it's at record levels. The value of external refinancing was actually up 21% over the last year. So there's been a lot of refinancing going on. And you can just look at the graph that we've got in front of us to see the scale of how much refinancing has occurred. Really, for me, it's been a significant rise, which really started with the pandemic. So, what I saw on the ground at PPA, as soon as the first lockdown started, was, the fear of God went into all of us. People were losing jobs. Everyone was, we were having conversations worried about what would happen to the property market. Initially,
no toilet paper.
That came later.
Karen's belting each other up in the eye.
Yeah. So, but this it's really quite visceral, the memory for me in that first month or so. We had people, not the toilet people fighting for the toilet paper, but what it felt like with our team and working from home and having just the most number of people ever contacting us, people in tears, people losing jobs, people trying to pull out of purchases, but a lot of people who weren't in those difficult positions, but they just wanted to shore up their cash flow. And so, it really was chaos, and our team did an amazing job living through the fear and uncertainty themselves, whilst handling record numbers of inquiries. We're working long hours, and on some level we were counsellors, which now the mortgage industry actually focuses on training mortgage brokers to understand better how to do and how to forward people on. But so there were people seriously distressed, and really a lot of people refinanced then because they weren't sure, they were so uncertain about what the future held that people were looking at any way they could shore up their cash flow. We remember, you could take money out of your super. There were all sorts of things going on. So that started a big bounce, which you can see in the graph. And then I think once we got a bit of stability in the economy and the property market, started to rebound, refinances fell off. But then I think once the property market slowed down again, the banks really started offering the cash backs and, doubled down on their refinancing efforts. And so we've seen these record volumes, over that lengthy period.
Oh, it's insane. It's a crazy chart, and I just held it up. For our listeners who are listening to us in their earpieces, we'll pop this in the show notes. But we've also now got ourselves onto a YouTube channel, and we'll also try and show some of the data there. So, yeah, a little bit of a change for the property trio. Anyway, Mike,
Jump on the YouTube channel.
Yeah. See us horsing about with expletives and
I'm sure some
Mike
of
with
that'll be
his
there'll have to
cancel
be a
button.
beat put over me
Yes.
reading Mike's actual script this time.
Or leave it. Who knows?
Like, the numbers seem large. For example, $350 billion worth of fixed rate loans expiring. What's the data pointing to?
They do seem large, right? And I think
Yeah.
that's what the media kind of zero in on. And the RBA's even given some advice for commentators in how to calm down a little bit. Their statement of monetary policy found that the expiry of the fixed rate terms peaked at just under 5.5% of outstanding credit in the June quarter. So 5.5% of outstanding credit. That was what it amounted to, the expiry of those fixed rate terms. So
Over a 3-month period.
Yeah.
It's pretty small, isn't it?
yeah, it's very, very small. And they basically said they remain a low portion of outstanding credit month to month. You can see in the graph, and this is probably a YouTube one, but we'll try and share that. The surge in the fixed rate borrowing through COVID still only saw fixed lending peak at 40% of outstanding housing credit in 2022, and we'll share that graphic. But it also didn't last very long, and we've gone basically back to lending on a variable rate. So we're sitting probably closer to sort of 7 or 8% at the moment. It may have gone up a little bit in the last little while. So that means the vast majority of housing debt is on variable rates, and to contrast it to fixed rates, variable rate borrowers have already been exposed to a lot of the cash rate rises. So, based on average outstanding lending rates, an estimated 80% of the 400 base point increase as of June. So these variable mortgage holders have been sort of beaten around the head a little bit, and of course we can see they're feeling the pinch with cost of living pressures, and some of the data's still coming, and consumer sentiment is a little bit low, but arrears remain in check and are below pre-pandemic levels. And with the market sort of bouncing back from February, this has really sort of reduced the possibility to be in negative equity. And I think there's probably a lot more to be positive about than the media would let on.
Yeah, I agree. This chart looks like Ayers Rock. No, should I say Uluru?
Yeah.
So
You should say that.
It's clear to see that even during the spike of fixed rate mortgages, the majority of households were on variable rates, and the vast majority from mid-2022 were already electing for variable rates. Dave, what have you observed?
Firstly, that's a great point that Mike's just made. The majority of borrowers, which is those on variable rates, as he's just gone through, have lived through these rate increases for over a year. And so if anyone should be feeling a cliff, it's those who've been on variable rates. They've been climbing up a cliff for a long period of time. The reality is those coming off fixed rates have had multiple advantages versus all those with variable rates, which that isn't talked about in the media.
Yep.
So their rates have been lower for longer. That's an advantage. Self-evidently, the interest they've been paying has been lower during this period. So that's allowed them extra time to prepare for the repayment increases that they've known were coming, for 12 months or 18 months. It's allowed them to build up a greater level of savings, to adjust their spending, potentially increase their income, and to be able to have a plan for how they'll meet the higher repayments, or in a worst case, manage the sale of an asset. So, at the same time, salaries are rising at the fastest pace they have for a long time, and the property market has been rebounding for most of the year. So there's very few people with negative equity, and Mike just taught us how psychologically that really impacts people meeting repayments. So there's a flip positive side to the coin of being on a lower rate for a longer period of time.
Yeah, it doesn't seem all that bad, does it, Mike?
No, I think it's been over-egged a little bit, and that's what the media's here to do, right? They've got to get clicks, they've got to sell papers. I don't even know if they still have papers anymore.
I get a paper delivered every day.
Do you?
Yeah, old school. Yeah, Financial Review every day. I love it.
I'm so the young pup of this trio. I think what commentators and even economists sometimes think is that not everything sort of works on a linear plot that you can look at. I think people are resilient and they'll make adjustments to the family home. It's something that they're going to fight to rather than go, you know what, I'm not going to cancel my wine subscription. I'd rather sort of foreclose on the home. I mean, it's a bit of a ridiculous sort of thing. The latest APRA publication is showing housing credit in arrears at an extremely low 1.2% of outstanding debt. So I think there are some definite pain points, and there is a disparity between non-bank lenders and bank lenders. And like as Dave said, you can plan for this increase in your interest rate. So if you haven't and you're listening to this, log on to your bank and see, well, when does your fixed rate term expire? It shouldn't be a surprise. It shouldn't be, gosh, I've gone from 1.9 to 7% and everything's going to, the world's going to fall in. People should have been able to plan for this.
Yeah.
Yeah. I think that our RBA and particularly APRA have done a great job in the earlier days of prepping us for having reduced household debt and for having a bit of a war chest. But the media cries that we heard when all of this was breaking, interest rates kicked in, were more about the buyers that were caught short and hadn't experienced lending conditions prior. So first home buyers who took out their first mortgage when interest rates were at 2%. And that would be a bitter pill to swallow if you weren't prepared for this, because we know, those of us who've been in the property, invested in property for a couple of decades, know that 2% was never a sustainable rate. We always knew that it should revert back to something that would become the new norm. And I remember over 7% was the norm when I first started out. It's now somewhere closer to high fives. Is that right, Dave?
High fives for what, sorry?
Like the equilibrium for an interest rate?
Right now, yeah, probably around high fives, that's right.
Yeah. So I think it can be difficult for someone who's uninitiated. But what this episode's taught me is so much about the media beta and putting it into perspective and understanding just how many borrowers out there are subjected to difficult conditions and what we'd call a mortgage cliff. And we always have to put this in perspective. 1/3 of people have a mortgage, 1/3 of people have already paid off their mortgage, and 1/3 of people rent.
Look, I think personally, I think a gradual rise in arrears over the coming 12 to 24 months. As we've just covered off, I think hopefully our listeners, understand. They're very educated people, our listeners. So, these things don't just spike rapidly like the media has been talking about. As you touched on, Mike, people do everything they can to keep properties, especially homes. The banks nowadays also provide a lot of support to those in trouble if they reach out, such as reducing repayments, moving people to interest only, extending out the loan term to 30 years and similar. ASIC has written to lenders expecting that the lenders will work with customers experiencing financial hardship as much as possible. So it's not as cutthroat in residential lending as it once was once upon a time. And, it's probably even less so since the Banking Royal Commission again. So, look, I think the sleeper is the non-bank lending area, but they're a very small part of the lending landscape. And I think, what's probably going to be worst hit, we're already seeing that, is developers, is the commercial property market. And, by the time this all flows through to the economy and interest rates start reducing, paradoxically, residential rates, property values will probably increase again off the back of reducing interest rates, even though that's the point the economy is feeling it the most. So residential property is pretty buffeted and protected overall. And, as we've joked about before, residential property in Australia is too big to fail. Too big for the government to allow to fail.
Really good overview. I think on that note, we're going to move through to our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget is that while the pain is on people that have switched to a variable rate and the screws are really being turned on them from a cost of living point of view, we're going to start seeing that in the data, and that's probably going to help with some of the inflation that we have in the economy. What's really, I think, contributing a lot to inflation is things like petrol and energy and rents. The rest of the economy, you can see spending start to moderate. And yes, I think we're likely to see an increase in delinquencies, but I don't think it is a mortgage cliff. I think it's a huge beat up. I've even got a button for that, I think.
A complete load of...
I better stop that one. What we also need to consider is that the RBA is keeping its powder dry for further rate increases, but a lot of commentators are saying that we could see cuts the end of this calendar year. If not the end of this calendar year, we're talking about next year. So that pain, that ratcheting of pain is going to be short-lived, and I think that's going to sort of form its way into the equation as well. It's not a cliff. That's my summary.
Yeah, great one. Dave?
Yeah, I think it's not a cliff either. This is going to have a slow tail. The economy is going to feel pain over the next year or two. As I touched on, commercial property, non-bank sector lending is going to feel pain. Developers but the residential property market really led the way in terms of signalling the downturn, with the property market falling last year, well in advance of things happening in the economy, and I think it'll lead the upturn and the swing out. And as I just touched on, when rates start to reduce, property values are likely to climb again, which they're already doing right now, even if we're about to start plateauing to some degree.
Yeah, I think overall, I would say that there will be a mortgage cliff for some individuals, but in terms of the greater buyer population out there waiting for the market to collapse, I don't see that happening. We have to have a look at what's on the other side of that force field. So we've got new arrivals in number, and they're skilled migrants, and they are buying. We've also had a rapid increase in rents. So for investors who are looking at their holding costs, they've had that somewhat offset. And we have to think about what inflation does to property values. I mean, we're living through that right now. We've had some positive price movements on our property. And lastly, we've got almost record low unemployment. So people are employed and they're confident. And we're seeing a little bit of movement on wages growth. So I think there's enough confidence there, and there are enough others to soak up any distressed sales for it not really to even be a blip, in my opinion.
Yeah, awesome. I think that's those double trigger that we talk about in that RBA hypothesis. Negative equity and income shocks. They require higher unemployment, and they require negative equity, and unemployment's so low and negative equity, at 0.5%, that's likely to be eroded in the next couple of months as prices continue to go.
Buy good property, be good at your job, and then have income protection.
That's great advice. Simple but great advice. Well, it's been a great one. We've gone a little bit over time, but we're getting better.
See you next week,
you
everyone.
guys. Great job, Mike.